And then when you think about the beauty of compounding,
Yeah.
when you get to preserve more of your wealth year over year, that also benefits from compound returns. So after a number of years, being mindful of the tax scenario on a managed account can provide incredible value to an investor. And the way that's done, a really, really simplistic example is tax loss harvesting. And a common, refrain from investors is, why in the world do I want a loss? Why is a loss a good thing?
Right. Losses always sound bad. Hello, Apriem family, and welcome to episode 20 of Apriem Financial Cents. I'm really excited about this episode because I got to meet with Laura Foster, who's the Managing Director of Private Wealth Solutions at Canvas Custom Indexing. And the reason I'm so excited about this is because our whole conversation circulates around this strategy for very tax-efficient investing that historically really has only been available to the kind of ultra wealthy. But due to changes in the industry, advances in technology, changes in pricing structure, all of a sudden this strategy has become available to the everyday investor, and it's getting a lot of attention. So I hope you enjoy the episode. I hope you get a lot of great education out of it. Please remember to like and subscribe to the channel, and let's get into the show. Well, so why don't you tell us a little bit about, what exactly is customized indexing, direct indexing, personalized indexing?
Sure.
I feel like
Sure.
since I started diving into this, I'm getting all these different terms,
Sure.
but it's all the same thing, right?
Yeah.
Okay.
It's, if you think about it all to be on a spectrum, they're all, on the same wheel.
Yeah.
I think the terminology might hint at certain different skills or specialties. Sure. But at the core of it, one of the most important characteristics is that each investor has their own brokerage account. Nobody is lumped in together. And at the heart of that is customization and design that's meant for the individual. And if you broaden out, the easiest way I can find to think about it is to consider it an unwrapped ETF or an unwrapped mutual fund.
Okay, so before you go further into that, just because there's going to be varying levels of clients that we have that are listening to
Sure.
and watching this, we just unpack a little bit about ETFs, mutual funds.
Yes.
And when you say it's unwrapped, explain a little bit about an ETF mutual fund to us.
Absolutely. So ETFs and mutual funds are pooled investment vehicles that house assets that follow some sort of investment ideology and thesis and policy. But the pooling function makes it more accessible to every person to have a slice of this pie, since you don't have to go out and buy the individual shares yourself. You have the manager of the fund or the manager of the ETF doing that on behalf of you, and you get to participate in a slice of that pie. So I do definitely credit the fund and then the ETF for bringing diversified best-in-class management to the masses, because they are so efficient and easy to access.
Right.
But there are some downfalls because it is a one-size-fits-all. If you have unique circumstances, be that around your tax scenario or your values, or maybe some concentrations in other risk areas of your portfolio, you can't customize that holding for you.
Right.
You have to buy what they're selling, if you will. So while it's great for scale, efficiently, very cost effective, a great way to get access to good, high quality managers, there are some of these downfalls when it comes to what you might need at the individual level. And that's where moving into a direct index or a custom index, and having your own brokerage account where you are not mixed in with any other investors means that
Right.
you can control much more of your experience. And one of the main aspects that our clients control is their tax experience.
So, you kind of bring in the tax piece to
Sure.
it. So I know that is a huge driver of a lot of the benefit. Obviously the being able to tilt towards certain preferences,
Yes.
right? And if we have specific ideologies or things like that we believe in, right?
Mm-hmm.
But over and above that, I think the tax piece is really kind of number one when it comes to this. You want to talk a little bit about maybe tax loss harvesting,
Sure.
what that is, and we might have to talk a little bit about kind of ordinary income tax brackets and how they
Sure.
compare to capital gains
Sure.
as well, for this to really make
Yeah.
good, clear sense to everyone.
Yeah.
But I'm going to leave it to you to let you run on that.
Absolutely. I think in in the sphere of investing, of course, you want your investments to provide value to you and to pay you back. And taxes is one aspect of investing that can be turned to your benefit through changes in structure, changes in access. So it's a different kind of alpha than traditional alpha, where you might be reliant on a star PM who has great insight in the market and can get ahead of changing dynamics and make you some great money. Tax management and tax alpha is more about ensuring that you're not leaving value on the table, that you're smart about the way that you build a portfolio, the way that you access your investments, and the way that you manage it to take advantage of tax law and really help you keep more dollars invested in your investment portfolio rather than paying capital gains taxes, sending it out to Uncle Sam year after year.
And so that after-tax dollar amount that's in your pocket is larger than it would have been if you went a less tax efficient route, right?
Absolutely. Yeah. And then when you think about the beauty of compounding, when you get to preserve more of your wealth year over year, that also benefits from compound returns. So after a number of years, being mindful of the tax scenario on a managed account can provide incredible value to an investor. And the way that's done, a really, really simplistic example is tax loss harvesting. And a common, refrain from investors is, why in the world do I want a loss? Why is a loss a good thing?
Right. Losses always sound bad.
It always sounds bad. But if you do it in a systematic and rules-based way, you can capture the benefits of a loss for your own value creation. So a really simple example is, let's say you're holding in your portfolio and is now worth less in the market than what you paid for it. You paid $100 for your stock and it's now trading at $80. So you can sell that and lock in a $20 capital loss. And then you're going to go and buy and they operate in a very similar fashion in a portfolio. They have the same industry, the same sector, similar market caps, and other characteristics about these two stocks. So from a portfolio management standpoint, they look not identical, but pretty
similar.
Close. And when I do that, I can take advantage of the loss on that share, capture that $20 in losses, and then reinvest my funds into a position that is expected to give me kind of the same return as because I've moved over to So for an investor, what that means is that you're still tracking the market. You're not out of the market. You're not sitting on the sidelines. You are invested. You are in. But you've made a choice to capture this tax asset, this tax loss. And then you can use that loss in a number of ways. And that's going to depend on you as the investor. But let's say you have gains coming from a hedge fund that you own, or from just the sale, of a position that you sold off to fund a purchase of a fund, a boat or something like that. Whatever it may be that caused a rental property. You've got a capital gain, and that loss can offset the gain, and depending on the quantity of each, can take away your tax liability. So by putting in place a systematic process to find those losses and realize them, to make them yours, to capture that asset, you then have this tool that you can use to lower your tax bill when you're looking at your overall investment portfolio. And one of the best aspects of these losses is that they carry forward too. So you can, if you don't have gains to put them against in the current year, they come with you. So that's why I refer to it as an asset, is that it's something that is transferable and you can take with you until it's time to use it.
Yeah. A question I get all the time, and I'm teeing you up here. Okay. So a question I get all the time is, can't I only take $3,000 of losses each year? And that would be based on current law. I don't know in the future if that's changed, but as of right now, can't I only take $3,000 of losses?
That is one of the most common misconceptions. So that is about your ordinary income. You can offset $3,000 of ordinary income, but what we're talking about is capital gains and losses. So investment properties, investment portfolios, sale of a business. So it's a different segment of your wealth. that this applies to. And in that arena, you do not have this very rigid maximum allowance. So we very often will see portfolios, if it's a sizable portfolio, producing hundreds of thousands of dollars in capital losses that they are using to offset in commensurate amounts of capital gains.
Right. So it's giving you the ability to roll that forward year after year. Maybe you even take your $3,000 against your ordinary income.
Sure.
Right. But then you roll it forward. And then the big key here is it's got to be against capital gains.
Yes.
Right. And as long as it's against capital gains, is it unlimited the amounts I can take?
I believe so.
Okay. So
Mike, you as an advisor might have to check me on that one.
No, that's okay. Yeah. So pretty much, unlimited upside as far as, how much I can net against, as long as it's against a capital gain.
That's right.
Okay. And so just for the viewers, we're talking about capital gains. This is really important because a lot of times we might have an IRA or a 401k or a Roth IRA. Those types of accounts do not receive capital gains treatment. Right. So we're talking about trust accounts, joint accounts, individual brokerage accounts. OK, those are the accounts we get capital gains treatment out of. So we want to be very specific in our mind. We're listening to and thinking about this conversation, that we're placing all of these ideas on those types of accounts. So that I'm going to kind of bring it back over. So how long has this whole concept been around? I feel like I haven't heard about it, until relatively recently.
Sure.
Shame on me.
Sure.
But how long has this been around? What's kind of the history of where this came about?
Yeah, this type of solution has actually been around for over 30 years. So it is not new, but it is newly popular. And there's some reasons for that, some very good reasons. And the biggest one I would point to is custodial transaction fees. I think most folks are aware they're pretty much free now. You can buy and sell stocks without paying a commission. But just a few years ago, it was $5 a trade. And not many years before that was $10 a trade. And it was probably even higher than that a few years before that. So what that meant is that to actively be trading and capturing those losses was expensive for the investor. So it only made sense for very large portfolios to use this type of investment style. And that actually is where this originated, was with a family office in the Northwest, suffering some pretty heavy tax pains, that worked with a manager to create a way to really capture S&P 500 like exposure, but be advantageous when it came to kind of looking at tax law, and doing this active tax loss harvesting process. So that was really the origin story. And then it blossomed into a larger scale offering for more and more types of investors, especially as the custodial pricing came down and really lowered the penalty to access this type of management. So now with essentially free trading at your Schwab, your Fidelity, and many other custodians, it really lowered the account size that made sense to invest in this type of solution. And I think that's a primary reason why you are seeing the proliferation. But if you also remember, 10-ish years ago, the sunset of the Bush era tax rates. So our capital gains tax rates went up significantly when that period ended, which meant that many investors were suffering more from those capital gains tax rates and urgently looking for solutions to make their investments more efficient and make tax law work for them. So those things combined, I would credit with more of the explosive growth of this type of offering.
Yeah, it seems like the barrier to entry has really come down a lot.
Significantly.
And as you were describing some of that, I think there's some things we can bring some great clarity to here.
Yeah.
So we were talking about, the amount of trades, right? And so when you used to have to pay commissions per trades, all that trading that could occur throughout the course of the year could be very expensive. Right. And
Absolutely.
that would have been one of the reasons why ETFs and mutual funds would have been so popular, right? We could get exposure to hundreds or even thousands of companies, but place one trade per ETF or mutual fund, right? Versus having to do a whole bunch of trades.
Yes.
So on that topic, how many positions would somebody expect to see in their account if they started doing this kind of customized indexing instead of holding one ETF tracking an index?
Sure.
Right. In this case, they're holding, primarily a bunch of those companies that would have been inside that ETF. So what would they expect to see inside their account?
Yeah, great question. And I think it's one of the biggest areas for a learning curve when you're transitioning to this style of portfolio management. But a typical account might hold 200 to 400 individual equity positions. And if you go back to what you just described and think about an ETF or a mutual fund, investors are exposed to thousands of individual positions through those vehicles. It's the access point that makes it appear as though you're holding a single security. So in these portfolios, going back to the concept of unwrapping the ETF, kind of breaking open into what's underneath. Right. Now you're owning those individual positions outright in your very own brokerage account. And a large part of the reasoning there is to be able to take advantage of that single stock volatility and sell that, buy that, keep your portfolio on the rails, but take advantage of that trading to preserve value after tax.
All right, so in my mind, I felt like I could hear everyone that's watching gasp. Like 200 to 400 companies, like that's crazy. And so I think that can probably be one of the most shocking pieces there. I feel like one of the questions that people get is that adding more risk by any means to my portfolio? I mean, when we think about customized indexing, what are some of the biggest risks that people are taking on? The tax loss harvesting sounds fantastic. And the fact that we can do this kind of add these kinds of benefits to somebody's account. But there's got to be some downsides. What are the downsides? People should be aware of.
Indeed. So whenever we're managing these portfolios, while we're holding a pretty large number of positions, we're not holding every single position that might be in the index or the mandate for the ETF. So if we use a simple example of an S&P 500 ETF, it's going to hold 500 positions underneath the hood. And the performance of that vehicle is going to be very, very, very tight to the performance of the S&P 500. So almost no deviation. When you invest in a direct indexing portfolio or a custom indexing portfolio, we use an approach called optimization, meaning we're pulling a lot of different characteristics of those stocks that make up the S&P 500 and buying a subset that will keep your performance very tight but not exact to the index. So within that means you have some room for wobble around the performance of the S&P 500. Usually accounts are managed within about 1% wobble, meaning you might overperform or underperform the index by about 1%. But it's certainly something to be aware of. And that's the trade-off that you make to access this tax loss harvesting and be able to gain access to those valuable tax assets. So that's probably one of the main just points of differentiation between the investment vehicles to make sure that clients understand. But just if you zoom out and go back to thinking about the way that investors own these positions, you are going to be working with your advisor and a manager. So there's a manager involved that helps the advisor to buy and sell those positions on your behalf. But because you own every name in your very own account, that manager could go away tomorrow and you still own everything that was in your account. So in some ways, it's actually, I would say, a more direct access point and gives investors more control over their holdings, which I think is easy to gloss over, but a very important part of the relationship. And then, I think it's important for investors to understand the value that is achievable with these solutions, but then also look at their own individual scenarios and whether it makes sense for them. You had mentioned earlier that the type of account is important. If we're looking at an IRA or any sort of qualified portfolio, this may not be the right approach because that tax management is not really going to bear fruit in that type of portfolio. Even in a case where an investor is experiencing capital gains taxes on their portfolio or has the potential to, it's a non-qualified investment. But if they aren't realizing, liquidating and realizing gains, maybe another place to reassess and say, do I need these tax losses? Can they actually help, reduce my tax bill, or is there nothing to offset them against?
Right. Nothing to gain out of this.
Yeah, exactly. So I do think that it's a solution that has a lot of value creation, but it's not for everybody in every circumstance.
Right.
So making sure that you're kind of doing that due diligence and assessing the alignment of the solution to make sense and make sure that the value is created for the investor.
It's another tool in the tool belt, right?
Totally.
You use the right tool for the right job.
Yes,
right?
exactly.
Right?
Exactly.
So how about, last question really here. We have all these positions that are in there. How frequently would somebody expect to see trades happen in their account? I mean, is it once a year or is it daily? I mean, what would be an expectation for the amount of trading happening in there with that many different positions?
Yeah, I would say a good rule of thumb is to expect about 12 trades a year.
Okay.
Maybe more, maybe less. A lot of the trading is going to be dictated by market volatility. So if there are periods where the market is really kind of dipping and rolling and moving around,
super volatile,
you should expect to see a bit of additional trading, and that's to preserve and get access to those tax losses and lock them in for the investor. Yeah. So when things are going crazy, you can look at your account and have a pretty good sense of comfort that the manager's going to be in there trading and trying to create losses and preserve them for you. And then otherwise, of course, we want to make sure these portfolios are still, tracking a benchmark like the S&P 500.
Right.
So if there are positions in the portfolio that start to run, get a little overweight or underweight, then there could be risk managed trades where you're trying to bring that back in line for the portfolio. But I would say it tends to work out to about 12 trades a year, maybe 10 to 14 or so, taking advantage of that volatility for tax loss harvesting and then making sure the portfolio risk is aligned.